Welcome to the Script Page channel. Have you ever stopped to wonder what really drives the financial markets? I mean, we naturally tend to think it's all just pure math, right? Corporate earnings, economic data, complicated algorithms. But beneath all those charts and numbers lies a hidden, incredibly powerful current, and that is human emotion. Today, in this explainer, we're going to decode the psychological forces that actually move the market. We're going to look at exactly how crowd psychology works, and more importantly, how you can start separating your own ego from your money. Okay, let's dive right in.
Before we get into the heavy mechanics of it all, I want you to ask yourself a quick question, and I want you to be completely honest here. Have you ever held on to a losing investment simply because you didn't want to admit you were wrong? You know the feeling. You watched the price drop, but your pride told you to hold on, hoping, praying really, that it would bounce back, just so you could break even and save face. Well, if you have, you are definitely not alone. The market is literally full of incredibly logical people making highly irrational decisions, all because they let their personal feelings dictate their financial reality.
So here's our agenda for today's explainer. First, we'll cover the psychology of market cycles. Then, overthinking and inverted reasoning. Third, we'll look at the myth of they. Fourth, the panic and the boom. And finally, we'll wrap up with mastering the investor mind.
Let's kick things off with Section 1, the psychology of market cycles, and how crowd emotion moves markets.
Think of the entire market as just a giant emotional barometer tracking our collective psychology. Sure, the broad, multi-year movements might be based on fundamentals, but those day-to-day, month-to-month fluctuations, that is pure human hope and fear measured in dollars. It drives what we call the speculative cycle. Imagine we're at month 1. It starts in total dullness and apathy. Prices are dead, nobody cares. By month 3, there's this gradual rise, but everyone is super skeptical. No one actually believes it's going to last. But then, prices just keep taking upward, and we hit month 6. Now we've got public frenzy and greed. Everyone suddenly thinks the market is way too strong to fail, so they buy absolutely everything in sight. By month 9, we reach the tipping point. The smart money is quietly handing off the shares, selling to that enthusiastic public. And finally, by month 12, the heavy load of those stocks crashes down into panic and collapse. It's this relentless, predictable cycle of human nature just running over and over again.
Moving on to Section 2, overthinking and inverted reasoning, or the very real danger of outsmarting yourself.
You know, seasoned retail investors often trick themselves into terrible trades just by overcomplicating things. Instead of doing straightforward, logical analysis, they develop this bizarre cynicism where they distrust the obvious. To understand why we do this, we really need to look at a concept called discounting. This is the process where the market anticipates and prices in future events long before they actually happen. It completely highlights our human tendency to confuse the present with the future. Think about waiting for a delayed subway train. You've seen it. People will stand right on the edge of the platform, anxiously craning their necks, practically tensing their muscles as if their sheer physical effort is going to make that train arrive faster. We apply that exact same ineffective nervous energy to the market. When good news finally comes out, we rush to buy, totally forgetting that the market has likely already discounted or priced in that exact news months ago.
And because of this discounting effect, experienced traders often fall into a massive trap called inverted reasoning. Have you ever heard someone grumble something like, "Oh, they just put out this good news to sell their stocks on"? That is inverted reasoning in a nutshell. A trader starts assuming every piece of good news is actually a trap set by insiders. Out of sheer cynicism, they might actively fight a rising, perfectly healthy trend, utterly convinced it's all a trick. They do these mental backflips until their own logic is completely twisted inside out, and they end up losing money simply because they refuse to trust basic common sense.
Which perfectly sets up Section 3, the myth of they. Who is actually controlling the market?
We literally just heard a hypothetical trader blame they for putting out fake news. When we lose money, it's a very, very comforting lie to tell ourselves that some shadowy, united group of powerful insiders manipulated the entire market against us. But let's actually break down who they are. First off, you have massive institutional capital. Second, you've got floor traders and market makers. And third, millions of global retail investors, just like us. The absolutely crucial point here is that they is not a coordinated army answering to a single commander. Actually, they is just a massive, uncoordinated mob. It's a highly chaotic mix of varying human opinions, conflicting strategies, and vastly different amounts of capital. There is no omnipotent group orchestrating every single market drop just to steal your specific shares. It's simply the combined weight of worldwide buying and selling.
All right, Section 4, the panic and the boom. Let's look at the extremes of market emotion.
Now that we've established the market is basically a giant crowd, what actually happens to human rationale at the absolute extremes of this cycle, the very top and the very bottom? Well, in a boom, the frenzy is driven entirely by euphoria and imaginary wealth. People pull up their portfolios, they feel incredibly rich on paper, and they start spending recklessly. They even take on huge margin debt to buy more. But compare that to a panic. We so often assume panics are driven entirely by blind fear. But the truth? The absolute bottom of a panic is actually driven by cold, hard necessity. It's forced selling due to exhausted liquid resources. People don't just sell because they are scared. They sell because they literally run out of ready cash and are forced to liquidate at whatever horrible price they can get just to survive.
And that brings us to our final section, Section 5, Mastering the Investor Mind. How to detach your ego from your capital.
We've looked at the macro crowd, but now we really need to zoom in on the micro level. How do you fix your own internal biases? How do you stop letting your personal positions and your ego hijack your logic? Let's compare two very distinct mindsets. First, the impulsive trader. This person acts purely on emotion. They see the market surging, they feel that intense FOMO, the fear of missing out, and they buy right at the absolute top. On the flip side, we have the phlegmatic trader. This person is methodical, cool-headed, and unemotional. They don't chase the rallies. Instead, they patiently wait to take advantage of the crowd's irrational swings. They buy quietly during the declines, right when everyone else is freaking out and panicking.
So how exactly does this phlegmatic trader operate in the real world? Well, one of their absolute best tools is the scale order. This is a strategy of placing automated orders to buy or sell incrementally as the price drops or rises. So instead of nervously betting everything all at once, they might set up orders to buy a little bit more every time the price drops another dollar. It completely removes the emotion from the equation. They are systematically absorbing the market's nervous fluctuations without ever letting fear dictate when they enter the market. It's like putting their strategy on autopilot.
So, what are the big takeaways from all this? Here are the most common psychological pitfalls you absolutely must avoid. Number 1, avoid personal bias based on your current holdings. Number 2, stop confusing the present with the future. Number 3, do not trade so heavily that you become anxious. Seriously, if you can't sleep at night, your position is simply too big. Number 4, ignore the hunch. Unless you have decades of hard-earned experience, your hunch is usually just a disguised emotional impulse. And finally, don't let enthusiasm cloud your intellect. The market is relentless. It cannot be budged by your logic, and it certainly doesn't care about your enthusiasm. You must fit your interests to the cold, hard facts.
To help you actually do that, I've got a clear 3-step mental checklist you should run through before making any move. Step 1, check your emotional state. Ask yourself, are you acting out of fear, greed, or maybe just boredom? Step 2, ignore your current market position. Now, this is the hardest part. You literally must forget what price you bought a stock at. The market does not know or care what you paid for it. Step 3, analyze the actual fundamental trend. Once you've successfully stripped away your ego and your purchase price, you can finally see things clearly enough to judge where the market is actually heading.
Before we wrap up, I want to highlight this incredibly powerful concept. In the market, to be consistent is to be stubborn. Think about it. In almost every other area of life, whether it's business, sports, or relationships, being determined and consistent is a huge virtue. But in the financial markets, being a strong-willed, unwavering person is often a massive financial liability. The market requires you to adapt instantly to new data. If the facts change, you have to change your mind immediately. Consistency here is really just a polite word for stubbornness.
Which leaves us with this final, rather provocative question to ponder. Are you a reasoning optimist, or are you just hoping the market will magically bend to your will? A reasoning optimist doesn't blindly believe the market will always go their way. Instead, they believe in their own ability to stay calm, to interpret the facts without bias, and to comfortably float with the tide rather than frantically fighting it. Ultimately, mastering the market isn't about outsmarting millions of other people. It's about mastering your own psychology. Thank you so much for joining me on this explainer, and I'll see you next time as we continue to break down the world's most fascinating concepts right here on the Scripts Page channel.